Well, hello everyone and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's session that's being brought to us by qplum on the use of ETFs in active investing. I'm very pleased to have Hardik Patel with us, the machine learning engineer at qplum. But first, what I am going to do is pass the controls over or bring on Ji Chen, who is the head of client relations at qplum, to give us a little bit of background and to introduce today's speaker. So, Ji, thanks for joining us. Let's go ahead and get started here today.
Okay, thank you so much, Cynthia. Hello, everyone. My name is Ji Chen. I'm a partner and head of client relations here at qplum. Our speaker today is Hardik Patel. He is a partner and machine learning engineer at qplum. So qplum is an AI-driven asset manager using both deep learning and machine learning in its strategy construction. We provide asset management services to our RIAs, family offices, and pension funds. We also have an online investing service to directly manage money for individuals and families. We actively manage individual joint IRAs, trusts, and LLC accounts. Now, to all of our attendees, during the course of this presentation, we will please feel free to submit your questions to us as we will answer them at the end of the presentation. And so without further ado, I will hand over the presentation to Hardik to begin the presentation on use of ETFs in active investing.
Hi. Hi, everyone. Thank you, Ji and Cynthia. So without further ado, I'll get started on the topic. I want to talk about active investing and ETFs today. More specifically, I'm actually, when I say active investing, I'm actually referring to dynamic asset allocation. There can be other types of active investments as well, but we'll focus only on dynamic asset allocation for today. So this is the summary of what I'm going to talk about today. The first few slides are going to be about some brief overview of what dynamic asset allocation means. We won't go into details, actually, just we'll only try to get an intuitive sense of what it means. And then we'll take some time to review why are ETFs good for asset allocation, I meant dynamic asset allocation, and what is it about them that makes it more suitable for this kind of investment as opposed to, let's say, stocks. And after that, we'll focus the second half of the presentation on constructing a dynamic portfolio using ETFs. So we'll try to come up with one way of doing that. There can be other ways, of course. So let's get started. Dynamic asset allocation. So asset allocation as a whole is a very big thing, right? There are tens of trillions of dollars invested, and it's always hard to actually categorize asset allocation because there can be many different ways of viewing it. But here I'm taking one specific approach to show you where exactly dynamic asset allocation fit in. And so if we first categorize this into liquid and illiquid securities, so dynamic asset allocation is within liquid. Illiquid investments or illiquid assets would be things like real estate, private equity, venture capital, and all other kinds of things. Within liquid assets themselves, there can be many different types of investments. The most common and most popular, I wouldn't say most common, but certainly most popular one is discretionary investment, where someone who has some idea about, or someone has a bias and they want to invest based on that. They want to buy certain stocks for some companies and so on. Dynamic asset allocation is more of a systematic approach to asset allocation. So it's sort of exact opposite of discretionary. So you want to avoid the personal biases and those things when deciding which asset to allocate to or which asset to prefer. I won't go into details of pros and cons of each, because both have their own pros and both have their own cons. But this gives a rough idea of where does the dynamic asset allocation fit in. Just to dive in a bit more. So dynamic asset allocation views certain assets more favorable compared to others. This is different from security selection, where you bet on certain securities or you bet on certain companies, for example. And so at the granularity level, asset class sits sort of at a less granular level compared to, let's say, stocks. So it's a different way to view that. So often asset classes tend to be less volatile compared to stocks, individual stocks. When you do security selection, asset classes and geographies don't play much part, but in that dynamic asset allocations, that's actually the essence of it. This is a very simple example of dynamic asset allocation, let's say. So in this example, we see that the portfolio consists of 60% equities and 40% bonds in 2012. 1 year later, the allocation is slightly different. Bonds are favored a bit more. There is 50%, we're holding 50% bonds now and 50% equities. In 2014, it has changed again with 80% equities and 20% bonds. In 2015, again, we are changing the allocation. This time, equities are 90% and bonds are 10%. And 2016, again, we are changing the allocation. So this is a very simple example. In reality, you'd have many more asset classes, and they can change either on a daily basis, they can change on a monthly basis, they can change on a yearly basis. Depends on your portfolio, depends on what exactly is it that you're looking out of it. So we'll cover the next topic now, which is some nuances of ETFs that make them more suitable for dynamic asset allocation. So the first and the most important benefit of using ETFs is that they easily map onto asset classes. So let's say if your asset class is US real estate, you can find ETFs for that. You can find ETFs for US bonds, you can find ETFs for international bonds, you can find ETFs for international real estate, and so on. You can find ETFs for US utilities, you can find ETFs for US energy companies. While they in some cases they may not exactly represent the asset class, but more often than not, you would find that those ETFs would be correlated more than 98% with the asset class themselves. So this makes it very easy for us to represent an asset class using an ETF. In the absence of it, it would have been very hard. You would actually have to come up with a basket of stocks to represent an asset class, and even that could have a lot of tracking error. So that's a potential issue. So this is actually the biggest benefit of using ETFs to do dynamic asset allocation. There is another benefit when we compare it against, let's say, stocks. Because this ETFs directly map the asset class, you can use an ETF as a proxy for asset class when you're constructing a portfolio. And when you actually, let's say, when you have a portfolio, and now you have questions around why did this portfolio do this in this particular time period? you can easily go back and see that your portfolio is favoring certain assets by just looking at the ETF allocation. If you were to construct a dynamic asset allocation portfolio using stocks, it would have been harder because a single stock can span multiple assets, multiple geographies, and so on. It's much more noisy indicator of which asset it represents. So return attribution is much easier with ETFs. Also, costs are lower with ETFs. So there are two types of costs, of course. One is the implicit cost, which so ETFs have certain expense ratio associated with them, just like mutual funds. But index funds or index ETFs usually are very cheap, and even with that implicit expense ratio, it's actually cheaper to use that compared to stocks, because when we look at the exact requirement, which is we as part of the portfolio investment, we also would want to trade securities on the exchange, and that comes out to be cheaper with ETFs. That's just more of a empirical observation, but there are of course reasons behind it. And at the same time, we would want to be aware of certain caveats that are associated with ETFs. For example, leveraged and inverse ETFs can be so if you don't understand them, then it's almost always good to stay away from it. It can make it might sound like a very good thing at first, but in reality, they serve very limited purpose, and if you don't understand what that purpose is, it's actually very harmful. So in general, the best practice is to stay away from them. Also stay away from high expense ratio ETFs. So fees might not seem like it's a big deal, but when you look at, let's say, 10 years, 20 years, 30 years, those fee differences will actually catch up. Also, try to stay away from illiquid ETFs. Because there might be more tracking error and more execution costs that you may have to pay to actually get into the position. Also, it depends on how frequently you want to trade. If you're not trading that frequently, then maybe execution costs aren't that big of a deal for you. Another thing that you want to, which is associated with high expense ratio ETFs, is that index funds tend to be very cheap. So it's best to just stick to the index funds rather than going into other types of ETFs. In some index funds nowadays even have zero expense ratios, so that's a very good thing. So let's come to the third and the last, which will take up the most of the presentation. So we will go through a sample. We'll go through a sample pipeline for constructing a dynamic asset allocation portfolio. The first step, so there can be other ways of constructing dynamic asset allocation portfolios. This is one way that I know very well, because it sort of resembles what we do here at qplum, but not exactly. The actual process is much more involved and have much more corner cases and more details to consider. But this is a simplified version of it. So the first step is that you start with a large basket of ETFs. You just sit down, don't think about anything else. Just start with large list of ETFs. There are a lot of ETF issuers in the market these days, and so there is a lot of competition as well. And this competition is good for us consumers. So you would definitely be able to find a very large ETF, irrespective of what asset classes you're interested in. Some major issuers are Vanguard, BlackRock, State Street. You would most likely know most of them. Recently, Fidelity introduced zero fee index funds, which it's almost as good as it gets, I guess, unless of course someone offers negative fee index funds. But that's, I would say, probably for a few years or maybe a decade away. But it's possible to offer negative fee in theory, because you can always lend the stocks, and from that you can make money. So, but at this point, investing in index funds is almost like a zero cost thing. But getting back to the point, the first step is to simply create a list of ETFs. And so here I just wrote down some common ones that I know, common ETFs that I know. For example, VTI is mostly stocks, same is SPY, and then so on. The next step is to map this list of ETFs with different sectors that you're interested in. Another thing that I probably did not mention as of yet is that you also have to come up with a list of sectors that you're interested in, because ultimately you want to start with the list of sectors that you're in, list of asset classes that you're interested in, rather than just the ETFs themselves. So the next step is to map this list with different sectors. Your asset classes can be less granular. It could be a less granular example could be equities and bonds. Slightly more, or one another example of less granular could be US, developed markets, emerging markets. With these are three major classes. Then geographic asset classes, and then and then there is but you may also want to go into more depth and actually want to do various sectors like energy, financials, technology, or utility, or healthcare, and you would be able to find ETFs for each of them. And fortunately, because there are so many ETF issuers these days, it's easy to find those ETFs. And there might be some might have more assets, others not so much. There are different factors to consider, but the two main factors to consider are liquidity and expense ratios. So you want to select ETFs that have higher liquidity and low expense ratios. So usually, if there is more AUM in a specific ETF, then it would generally have higher liquidity. But ultimately, what matters is that it is how much is the bid-ask spread compared to the price, and how much is the volume. So let's just go through some examples before getting to the next slide, I guess. So for VTI and so for US stocks, VTI and SPY actually are very good representative of US stocks as a whole. Both are very liquid, both have low expense ratios, and yeah, they're highly correlated with US stocks. SPY basically tracks S&P 500, and VTI is more than 98% correlated with SPY and S&P 500. Similarly, you can find for US stocks, you can find US technology stocks, you can find VGT, QQQ, or XLK, or some ETF from Schwab or Fidelity. Similarly, for real estates, VNQ is quite popular. For international real estate, VNQI is quite popular, I guess. There is also AGG and BND for bonds. And you can similarly find specific ETFs that are more suitable for different asset classes.
Okay, everyone. At this point, what we're going to do is take a moment and go through our first poll question for everyone. And the question would be, just give me one moment. The question is, what are the benefits of keeping multiple ETFs for each asset class? Everyone, please take a moment and choose between A, increased portfolio capacity, B, tax optimization, if applicable, C, both portfolio capacity and tax optimizations, or D, none of the above. Okay, at this time, what we'll do is close the poll and share the results with everyone. So it seems like I'll let Hardik discuss the answers, Hannah.
Yeah, it seems like most of you got to share the opinions that I share, which is so it's while you may want to use ETFs that map different asset classes, but you can also use more than one ETF to do so. The clear benefit is that it increases the portfolio capacity, because that way you can actually share the trading load between multiple securities that have more or less the same underlying structure. Also, in taxable portfolios, it can be helpful to use multiple ETFs so that you can do some basic tax optimizations like tax loss harvesting and so on. But there is, of course, one caveat with that, because as per the SEC rules, I guess, it can, as per the rules for wash sales, those ETFs have to, if they share this exact same underlying index, then it can get wash sailed. So there are some caveats, but still you can do tax optimizations by using multiple ETFs for each asset class. But yeah, clearly the main benefit is the increased portfolio capacity. One thing that you can do is, while creating the portfolio, you can have one single ETF, but while actually implementing or executing the portfolio, you can do multiple ETFs. So that's one thing. Yeah.
Okay, so we'll go ahead and get back to the presentation.
Yeah. So far we discussed first two steps, which was create a list of ETFs, and second step was map those ETFs to various asset classes. Now let's look at the third step, which is processing data. Once you select the ETFs, the next step is to get the market data. And this is the most crucial piece needed for portfolio construction, actually. It can be expensive as well at times. And but you'd want to get enough historical market data so that you can do a lot of studies and you can be confident about various things. I would recommend getting at least 20 years of data. The more data that you have, the better it is. Also, there is so you would have to do some pre-processing on the data to make it usable. The most common ones that you would want to do for is account for splits and dividends, because ultimately you want to make sure that the return numbers are valid, and that requires us to approximately to appropriately account for splits and dividends, because because of that there can be price changes, and it would be very easy for us, or it would be quite beneficial for us if we don't have to deal with those things while constructing the final portfolio. Another type of pre-processing that we have to do, which is very specific to ETFs, is backfilling missing data. This is usually not needed for other types of securities. It's only Also, it can't be done for other securities, but it can be done for ETFs. So here's the problem. First ETF was created in 1993. There was no ETF before then. So, and the pace of ETF creation and investment in ETF is actually increasing. So you'd find a lot of recently created ETFs. For them, you will not have longer histories, and so that means your data is sort of constrained. You won't have last 20 years of data for most ETFs. So what do you do in that case, right? So if we take just one specific example, VGT is a Vanguard ETF that tracks US tech companies. It was introduced in 2004, I believe. That means we won't have data before 2014 for VGT. So how can we actually get that, right? Because we want last 20 years, and that means going all the way back to 98. What we can do is we can get the data for underlying index, because it ultimately tracks the index. It tracks some MSCI technology index, I believe. So we can get the data for underlying index. We can create returns based on that index for that index and use those returns to compute approximate daily prices for VGT for years before 2004. Just to be clear, this is an approximation, but it's still quite valid given that it ultimately tracks the index. So we can use that artificial price that we generated to assume that that ETF was traded and then this was the price and so on. So this is a very useful backfilling technique that we use quite often. If you can't get the index data, or if the index did not exist either, you can still do some other approximations. For example, you can find a very similar ETF, and as long as the correlation is more than 90%, 98% or something, you can use that correlated ETF to backfill this other ETF data. So yeah, this is the third step. We'll get to the next step, which is creating signals from our processed market data. So once we have the data, we can use that to generate our signals. The common ones are the ones that I've listed here: trend, RNN, or you could also come up with a Bayesian model to, if you have a certain prior understanding that you can express in terms of a statistical model. Value signal as well as expected yield are also quite popular, and so is the mean reversion. I would say trend has been the popular thing since late 1980s, and it's still quite popular, I would say. But yeah, so each signal has its own merits. There is no good or bad thing here. Also, it depends quite a lot on the type of data that you feed in. So if you, let's say, feed in just the ETF, just the raw prices or raw returns, then it would have certain meaning. But let's say if you feed in if you want to get a trend of technology asset class minus utilities asset class, then it would have a different meaning. So that basically gives you how much to bet on, let's say, differential of the two. Each of the signals or each of the strategies have inherent parameters associated with them, and the goal is to learn those parameters in an out of sample manner so as to not overfit there. For trend, the parameter is the look back period, how much to look back to get the average price or average return. For RNN, there can be millions of parameters or thousands of parameters, depends on your exact model. And same goes for all other signals. Ultimately, the output of these signals is weights for each asset class, and those weights sum up to 1 every single day. So you can, if you also want to allocate from time to time to cash, then you can treat cash as another asset class, but it helps to make sure that each day those weights sum up to 1. If it's a long only portfolio, you may want to restrict the weights to have only positive values. But even if it's a long only portfolio, you can still have negative and positive and do the positive only weights in the next step. Next and the last step in the portfolio construction is combining the signals that we just generated. So the signals would have a series of weights, one set of weights for each day. So let's say if we have a trend signal, then on August 1st, it would have weights for each asset class. It would have weight for US tech stocks, US utility stocks, US bonds, international bonds. There would be some weight for international real estate. There might be some weight for, let's say, Japan stocks, and so on. This for each. Similarly, there would be another vector of weights on the next day, which is, let's say, 2nd August, and so on. So for each day, you have a vector of weights. So you have this series, time series for each of the signals you get, and your goal is to combine them in some way. The most common method is mean variance optimization. You can also use linear models to combine them, and you can also use neural networks to combine them. At qplum, we prefer to use quadratic models though. For us, it's important to take into account things like execution impact, trading frequency, portfolio capacity, as well as divergence from benchmark and so on. By posing this combining signals part as a convex optimization problem, we're able to tackle those nuances much better, as opposed to, let's say, if we were to use MBO or if we were to use a linear model. So in a convex optimization problem, you have a loss function that you want to minimize. The loss function is a quadratic in nature, and you have a set of constraints on your parameters. The constraints can be soft constraints or hard constraints. The hard constraint you would specify by using inequalities, and soft constraints you can specify by adding to your loss function. And so once you have that definition, that convex optimization problem properly defined, you can use quadratic solvers to solve them. And when you, as an output result, what you get is again a time series with each date representing weights for each sector or each asset class, and again those weights sum up to 1. Since each sector is represented by an ETF, you in a way directly get the weights for ETFs. So you sort of know exactly how much dollar amount to invest for each ETF. Just to recap, because I mentioned a lot of things here. So you get a list of time series, and your goal is to combine them in a way that produces what you want to do. So ultimately, output of the dynamic portfolio allocation, dynamic allocation portfolio is is a time series where each date has a vector of weights, and those weights correspond to different asset classes. The reason you want to do this is that the objective here is you want to take into account the main objective that you have for each portfolio. Your objective might be wealth preservation. Your objective might be, let's say, not trading as much, or your objective might be that you just don't want to pay any taxes, or your objective might be that you have 20% risk, or your objective might be that you don't want to have a lot of drawdown. Your objective might be that you are okay with all kinds of drawdown and totally unconstrained portfolio with maximum returns. It can vary. By having this last steps, you're actually allowing yourself the flexibility to code that objective up into an equation and then optimize that equation. Another method that you can use for combining signals is reinforcement learning. The way it works is that based on your objective, you want to reward or punish reward. By punishing, I mean negative reward. You can provide a reward function to your reinforcement learning algorithm, and the objective of the reinforcement learning agent is to maximize the reward. So there are two main things here. One is to come up with a way to specify rewards, and another one is to learn the agent model itself very well. But this can be quite hard to actually successfully pull off. So at qplum we currently just use quadratic models, but this is something that can definitely be used, given that reinforcement learning algorithms are getting more and more robust for partial information games. So ultimately, this is investment is a partial information game where there can be other events happening in the world that is not captured through the data, and they can still affect things. But you still want to make good decisions despite this partial information nature of the problem. Okay, so just to recap, I mentioned 5 steps. First one was that you start with a list of ETFs. The second one was that you want to map those ETFs with different asset classes that you're interested in. The third one is that you want to process the data properly and then create signals out of them once you have processed the data. I mentioned I wrote down macro data and text data here, but I haven't actually delved into how you'd want to do that, but it's another big enough challenge to properly process and use them. And the last step is that once you have signals, you want to combine them to produce the portfolio that you want, based on your objective. So at this point, I want to go over a couple of biases as well as some details that are relevant for dynamic asset allocation. So the first one is to avoid look-ahead bias. It can, this is like the most common bias that's there. It can happen at multiple stages, of course. It's hard to actually it's not that hard to actually resolve it, but it's always good to be open to the idea that there might be some issue so that you can actually find them. So the most common place where look-ahead bias creeps in is when you're trying to learn the parameters of the signals. It's just very, very easy to do so. So if you just learn the parameter for, let's say, trend signal, and let's say if you ultimately learn that 200 days is the optimal look ahead bias, look back period. But if you decide that only based on the in sample data, then you have a look ahead bias, I guess. Survivorship bias is not that relevant here because unlike stocks which get delisted, the survive here you almost always have the asset class. Asset classes don't go away, right? The ETFs themselves might go away. It's possible, but asset classes don't go away. So that's hard. That's not that relevant for ETFs. It's relevant for stocks. Some common ML issues that creep in are that we often observe that in sample data as well as out of sample data can have very different distributions. And if you have machine learning models in your list of signals, then it's possible they may behave very differently out of sample. By out of sample, I mean not the out of sample that you tested, but the out of sample in the sense that the actual distributions that are going to data distribution that's going to happen from, let's say, today onwards, something that you have not seen as of now. So just being aware of it is a big step forward there. Then another common issue for ML models is effect of high noise. So because of high noise, you might feel like this is probably a good model, but it may not actually be a good model. So you actually have to scrutinize the model a lot more to gain some confidence. One common theme in this is to focus more on interpretability of the model. That helps a lot to make sure that the signals are, so it is able to learn something rather than just outputting random numbers. And the last of the notes that I have are around turnover and backtesting. So you do want to keep the turnover low. It has a lot of benefits, all the way from, let's say, execution costs and other things. Even if your strategy is, let's say, 50% annual returns or something, turnover does make a lot of difference. But at the same time, also 50% annual return is difficult unless you take a lot of risk. And even in that case, it's, you'd probably want to be prepared to lose almost everything. The another thing to keep in mind is whether you have a realistic backtesting engine or not. So your backtesting engine should penalize for low volume securities, as well as it should penalize high beta spread securities. It should penalize high trading. Otherwise, you would end up assuming that your portfolio has a lot of capacity, but in reality, it doesn't. And that actually, yeah.
Okay, so that will lead us to our second and final poll question. And the question, just give me one moment, is how does the final output of a portfolio look like? So the options are A, total return in the back-tested period, B, daily returns in the back-tested period, C, asset class weights at the end of the back-tested period, or
oh, the third and fourth ones are slightly
right. The D, daily asset class weights in at the back-tested period. So we will let everyone take a moment and complete.
Yeah, one quick note here. It seems like the option C and D are actually not correct. They were but I'll just move on. Yes, the option B is the correct one in the sense that the final output of a portfolio is daily. Um, sorry, sorry. The option D was the correct one, but it's not listed here. So sorry for all the confusion. But ultimately, what you get is a time series, and with each day containing a vector of weights, which is not displayed here. So we'll move on.
Yeah, just to let everyone know. So the response for this question, how does the final output of a portfolio look like? It would be, the daily asset class weights in the backtested period. Okay, so we'll go ahead and resume with the presentation. And
Yeah. So I just want to summarize before we open this up for questions. So what I wanted to get out of this presentation, or what I wanted to actually highlight, is that ETFs provide an efficient and cost-effective way to construct active investment portfolios. And what I did throughout the presentation was both provide a motivation for why we want to do that, as well as one such way to do that. There can be other ways to construct active portfolios. There can be other ways to construct dynamic asset allocation portfolios, but we discuss one specific one where we construct a set of signals and then combine them to generate a portfolio. Yeah.
okay, so at this time, what we'll do is we will open up for questions and see what everyone has comments on. Just give us a moment here while we go. So we have a question from Dominic, and the question is, how many ETFs of those most liquid are available to sell short?
That depends on the broker, of course. So it depends on so whether the broker has those shares available to lend you. Most brokers provide a way for you to actually see how many, whether or not you can short a specific ETF. I believe Interactive Broker also has a web page or API that you can call to get the list of ETFs that you can short, as well as probably the cost associated with shorting them, in the sense that cost associated with borrowing those ETFs. Yeah.
Okay, and then we have another question. This comes from Bill. In one of the slides, create signal slide, he's asking, what is an RNN?
An RNN is a neural network model where you take into account where you take in the history of the sequence while trying to predict the next one. So in a linear model, for example, what you would do is you would, if you want to account, let's say, near term history, then you would have to construct a feature on your own to, let's say, look back for last 5 days or look back for last 10 days and so on. For RNN, because it stores an internal state where it has an internal hidden state, it is able to remember some part of the history and actually use that to predict the next one.
Okay, great. And then another question that we have comes from Gregory, and his question is, can you tell us what conditions trigger a buying signal for a trend in real life?
So the exact way in which people implement or convert trend into buy and sell can be different from person to person. But one example can be that you can have a threshold, and then based on the threshold you decide whether you want to buy or sell. You can actually create 3 separate events: buy, don't do anything, and then sell. So you can have a threshold or 2 thresholds for them.
Okay, great. And then another question that we have is, sorry, just give me one moment. So I'd have you. This question comes from Roberta's, and is, have you backtested how your allocation aggregation compares to simple equal weighted allocation?
Yes, that's a very good question. We here at qplum, actually we started with equal weight allocation when we started 3 years ago, I guess. And over time we have evolved the way we combine signals, and we constantly, compare against equal weight as well as MVU and other methods. And there are, of course, different variants of the MVU itself, and we do that, and it depends on different portfolios. But yes, we do compare with equal weight allocation.
Okay, and then another question comes is what is the average number of ETFs in a typical basket?
That actually changes. That can be different for different people. First of all, it depends on how many, let's say, how big of a portfolio you want to construct, in the sense that if you want to have a lot of capacity, you'd want to keep more ETFs in your basket. But for most cases, you just start with one ETF per basket. Also, for construction process, it's often easier to just have one ETF per basket, even if you have multiple ETFs in the end.
Okay, and then another question comes in from Du, and this question is, what is text data as in market data?
Oh, that's yeah, there can be different types of text data that you can use. In the context of ETFs, so you wanna find the text data that would have or that might have had some impact on the prices, right? For single stocks, it's easy to find those things because you can find news, you can find trades, you can find the filings that companies have to do with the SEC. You can find all kinds of things. But for asset classes, you have to be a bit more creative, and you'd have to come up with your own heuristics and models to classify that, yes, this news is probably relevant to this specific asset class, or that news is relevant to that one. Also, you can come up with this mapping or this heuristic by actually seeing which companies contribute the most towards a specific asset class, and then using those news sources or other text data.
Okay.
And then you'd have to process that and use that in a way that makes sense, that the signal or strategy can understand.
Okay. And it seems like a couple of our attendees are asking for, where we could download intraday data for ETFs. So I know that in IB and Interactive Brokers, you could go to account management. In the message center, you could submit your questions to IB's API team. Another question that we have is let's see, which one would you want to?
Okay, let's look at.
Do this one.
Sure.
Okay. So Gregory has a question on where can we find your performance by strategies, and he also had that was.
So for the portfolios that we manage for our clients, we publish them on our website. For internal experiments that we do, we don't publish them, but you can find some understanding of those strategies by looking at the ones that are published on our website, and we do have monthly, quarterly breakdowns as well. You may not be able to find the exact day-to-day weights, but you should be able to find something similar, if not exactly that.
Okay, and we have time for just one more question, and this one comes from Nick G. And it's would it be viable to trade ETF options with the data?
It depends on what exactly is it that you're looking for. So if you're looking to do dynamic asset allocation, it's probably good to stick with just ETFs themselves rather than looking at options. Yeah, I'm not entirely sure how you'd want to go about that. But again, it depends on exactly what it is that you're looking for there.
Okay, and at this time we will want to thank everyone for taking the time and joining us today in today's webinar. Please, if you guys have time, please join us on September 20th for our next webinar in collaboration with Interactive Brokers on the topic of use of hypothetical data in machine learning trading strategies. And again, this will be live on September 20th at 12 p.m. Eastern Time. And for any attendees who are registered investment advisors, family offices, or pension funds, qplum offers actively managed portfolios at a flat fee. Please feel free to send any inquiries to contact@qplum.co. All right, Cynthia, I will now hand over the closing remarks over to you.
Well, G and Hardik, thank you so much for today's presentation. As G just mentioned, we've already got another webinar scheduled for September, and you can register for that on the Interactive Brokers website. Underneath the education menu, you'll find a webinar section where you can go into the upcoming webinars and simply sign up. I do want to let you know that whether you're able to attend live or not, by registering, you'll automatically get a direct link to that recorded playback. So make those choices here today, and you'll automatically be included in next month's event. So with that, it does bring us to the conclusion of today's event. Once again, thanks to qplum for a great presentation, and do be watching your email. We have been recording today's event, and we'll be sending out a direct link to the recorded playback soon after today's session ends. So with that, thanks once again for your participation with us here today. Have a great rest of your day, and you can exit by using the X in the upper right-hand corner of the screen. Thanks, everyone.